we're anticipating some cuts right now. We're seeing, mortgage-backed securities respond. The mortgage rates have come down. It's helping people bring a lot more people back into the market and be able to afford homes. But rates will slide down significantly more once we do start to see these cuts. And once we start to get closer to what we believe is, May, June, we should start to see some serious cuts from the Fed.
How's it going, everyone? Welcome back to another episode of the Shawn and Matt Show. My name is Matt, that is Shawn, and welcome to our show, Shawn. In today's episode, we have a very special guest with us. This guest started their own loan and mortgage company in the Northern Virginia area. You don't see that too often.
Not at all.
He is the CEO and president of Mabel Loans. Welcome to the program, Gerald Hanson.
Hey, thank you very much for having me, guys. I'm excited to be here.
Yeah.
So our goal, we have a very special job today, very important for the listeners and the watchers. We need to make talking about a loan not put you to sleep. Do you think we can do that?
It's tough. I mean, we can nerd out and we can get into some candlestick charts and, graphs and things, or we can, talk about it like just regular people.
This needs to be the Mr. Beast of mortgage in interest rate videos.
Yeah.
Shawn, do you watch Mr. Beast?
I do. Actually, my daughter watches
really?
Mr. Beast. Yeah.
Oh,
yeah. That's what got me into
okay.
it. And Mr. Beast is awesome. He's amazing.
Yeah.
But I wouldn't have gotten into it if it weren't for my 8-year-old daughter.
So we'll have to put something up, some kind of challenge, whoever, if you make it, making it through the end of this episode and, commenting below, something crazy is going to happen. They're going to bring back the Amazon cafe or something.
You get a 4% rate if you make it to this
4% rate.
episode.
Yeah.
Strings attached. You may not get a 4% rate. Okay, so let's get into it. Walk me through this. How did you get your start, and how and why did you start your loan company?
So I started off in my first job in mortgage. I had a good family friend who had just started a company. They had a long history of being in the mortgage business, but had shut down for a period of time and decided to get back in and start up a new company. So I was selling shoes and nice suits like you guys are wearing, very nice suits.
You can tell too.
Yeah, absolutely.
He would know if they weren't nice suits.
I absolutely can tell. I was a former life wardrobe consultant, and a good family friend of mine was starting this company, and I was thinking, hey, what is this mortgage thing all about? They were posting a lot about recruiting and everything, and I got an opportunity to do an interview. Night before the interview, I'm Googling, what is a mortgage? How does it work? And wound up going in, and it seemed like, hey, houses in Northern Virginia, they're selling, they're $1 million houses. So this should be easy when you start running what I call my Excel dollars, looking at your spreadsheet, putting it in. All I got to do is get, 2 or 3 mortgages a month and I'll be a millionaire. They don't tell you how difficult that actually is, to get those transactions. So started out in that company. There were about 5 or 6 people. We grew that organization to a little over 200 people. I was running a branch. Had about 50, people between loan officers and operations working in my branch, and everything was going really great. Just got to a point where there were some things in the business where I had some ideas. I said, "Hey, what if we did things a little bit differently?" A lot of it had to do with just making the purchase transaction a bit more informed for the buyers. So, educating buyers a bit more, being more transparent. And I had, some ideas on some pivots we could do with the business. And, how things go in big companies. It's like,
Absolutely.
all right. Yeah. Got kind of fell on deaf ears a little bit.
Yep.
So I'm not a big complainer. Who am I to tell somebody else what to do with their company? Go out and start your own company. Now at the time, there's a big thing in mortgage where they talk about you need millions of dollars to start a mortgage company.
Yeah.
And that was my thought. So I did not believe that it was a possibility, but I stumbled across a trade group, the Association of Independent Mortgage Experts, and they were talking about mortgage brokers. Which is a class of mortgage company. There's lenders, there are loan servicers, and then there are mortgage brokers. They're all types of mortgage companies. And it was pretty interesting. what it took, the capital requirements to get that started up weren't, something that I couldn't handle. And I said, okay, hey, I'm going to look into this, mortgage broker thing. And it's funny because at that company, we were a direct lender, and we would bring in, we'd have these big training classes, and I would educate people on the mortgage business. And I would always say how bad the broker was. You don't want to work with a broker. There's no control. These guys don't know what they're doing. And then, it turned out that was a little bit of maybe propaganda that had been, disseminating through the organization. And our company, we're independent mortgage brokerage. And I believe it's absolutely the greatest thing for me as a loan officer and an originator. And, through that gets passed along to being one of the greatest things for a consumer. So that's the story on how I got started with Mabel Loans.
So what is a mortgage broker versus the other things? What'd you rattle off? Broker, lender, bank, credit union?
So the experience for a consumer is basically going to be the same. Whether you're walking into your bank and speaking, it's always going to be a loan officer. So you're going to walk into your bank, you're going to talk to a loan officer. You're going to work with a direct lender, it's going to be a loan officer. And the same thing with a mortgage broker. There are direct lenders is really in the Northern Virginia area. There's some big, it's the mortgage capital of the world. That I would say some of the biggest direct lenders are right here in Northern Virginia.
Give us an example. Direct lender.
George Mason Mortgage, McLean Mortgage.
Okay.
Massive direct lenders.
You go to these direct lenders, you buy a house, you get a mortgage from them, but then they sell the mortgage.
Exactly.
So to me, direct, that's kind of confusing because I would think direct is I go to someone like a bank and then I just pay Wells Fargo like $4,000 a month or something.
Banks are going to be the only instance where people are really lending their own money. And in a lot of instances, it's actually the credit union that you go to that they would be lending their own money. Even banks are going to have other investors and they're going to be selling the loans off. Back in the day, you didn't get a 30-year mortgage. You got a 15-year mortgage. And that's because you were going to the bank every time and they were lending out money from the deposits from the institution. Then you have the invention of the mortgage-backed security where they could now go and sell these loans to pay off their balances and increase and do a lot more lending. So to get back to the question, the consumer experience is going to be the same. You're going to be dealing with a loan officer. When you're dealing with a loan officer at a bank or at a direct lender, they represent that company. So as a brokerage, you're independent. You represent the consumer. And you represent the consumer to hundreds of other lenders that are out there in the country, and they're considered to be wholesale lenders. So they're working directly with these mortgage brokerages, and they're competing for the business. They say, "Hey, bring your clients here. We want the business." So you tend to get some very competitive rates when you're dealing with the brokerages. There's some other regulatory differences with brokerages. Now, this is where we're going to get people falling asleep, talking about regulations and everything. But basically, we represent the client, not the bank. So if there's a loan officer working at one of these direct lenders and maybe the underwriting goes in the tank or, their pricing that week isn't that great, they don't really have any options as a loan officer. They work for that company that they represent. So, that's what I would say. Number one, being with the independent mortgage brokerage side of things, it's the best thing for the loan officer. It gives you a lot of freedom and control to be able to say, hey, if I don't like the experience with this lender, I'm going to go over here, take my business somewhere else. And it's very efficient, very easy to work that process with the way technology is now.
Yeah. So to put it kind of into an easier way to kind of describe this is like, if you're dealing with a direct lender, me as a real estate agent and my clients are talking to this lender and they are saying, this is the rate that I can get you. And, we have our own in-house underwriters and blah, blah, blah. That's one way of doing it. A broker would be like him. You contact him, then he contacts, he has all these other contacts out there, 1, 2, 3, 4, 5 different lenders that he's looking at. And he's looking at which one's the best rate, which one's the best option for my client. Now, the difference is typically, I don't do a lot of brokered loans. I have done 2 in the past 2 months, which is different from me. One thing that I will say is that when I talk to my broker, right, my broker sometimes, and I want to say this and I'll let you kind of respond, but sometimes their hands are tied in the fact that they have to go to that bank to get the answer, right? So they're not going to know the exact answer because every bank that you're dealing with in that horizon is going to have different things that they need. So for instance, right now I'm dealing with one where it's actually a portfolio product.
Okay.
It has to be a portfolio product because, and so it made sense to kind of broker this out because if you're dealing with a direct lender and it's actually McLean Mortgage that we're dealing with, but they brokered it out to somebody else.
Right.
And the reason they did that is because they don't have the portfolio product in-house to do that. So they have to call these other banks to see who has a product that can work. And the one thing that has come up, and this is the weirdest thing recently, there's a condo building out in Ashburn that does not allow conventional financing. It's FHA approved, but there's no conventional financing. And the reason there's no conventional financing is because first there's an HOA that covers the whole, area. Then there's a condo association. So there's 2 associations. And then on top of that, there is a mandatory club fee. And that had never been a problem.
Like a country club.
Like a country club. So it's Belmont Country Club out in Loudoun County. And because that is a mandatory fee, it has pushed out every conventional financing because what I understand is the Fannie Freddie guideline loans, right? The people that are the companies that are selling their loans on the secondary market usually have to have conforming standards that they're abiding by. And one thing that I learned over the last couple of weeks is that this topic has come up in the last year or two, that if there is a mandatory club fee, you cannot do a conventional financing. So everybody's like, I've talked to 40 different agents, and they're like, I've never heard of this. And then I would call lenders, and they're like, I've never heard of this too. Let me research.
I've never heard of it.
Right, exactly.
41.
So yeah. It was just such a weird thing. So the only way that we can get a loan in there is number one, to go FHA, which I don't understand why people aren't going more FHA if it's trading, and maybe you can explain that to us, or it's portfolio. And so, like I was saying, portfolio is when the lender holds it themselves. They hold that,
Right.
and they're not selling that mortgage. So we're hoping that this portfolio product actually passes. But the point is, we had to broker that out. So it was through McLean Mortgage, but now it's through, I don't even know who's doing it. And my one thing is, I'll call McLean Mortgage, and he's like, I don't have that answer. I have to wait to get the answer from somebody else. So that it's just like a third party kind of thing.
Well, I don't mean to toot the horn of brokers are better or anything like that. I mean, mortgage is basically a commodity at this point.
Sure.
So you're not really going to get a drastically different, pricing, and, hopefully everybody's got their act together. If you're not providing a good client experience right now, you're out the game.
That's
50% of loan officers have left the business.
Yeah.
And so, who's left? It's the dogs. It's the guys who can come in here and, they know what they're doing. So the level of competition, in the industry has really stepped up. Now, to first of all, congratulations, Belmont. That's very nice.
Yeah.
And it's very unusual that you would have FHA, because it's usually the other way around.
Yeah,
that you can't get FHA approval. I had never heard of that as far as the mandatory, club dues, or anything go. But I will say this: I came up in the business. FHA and VA loans were my number one product, and they get a really bad rep. Mm-hmm. Somebody will hear some horror story about, an appraisal where, oh my gosh, we had to paint a shed in the backyard, or, some obscure, guideline. And then all of a sudden it's like, I'll never take an FHA loan. The problem with that is people take these minority of, instances that will come up, and they'll make a new rule to apply. It's like, one time I had an FHA loan that didn't go bad, so now I'm never going to take an FHA loan, again, or I'm going to, poo-poo the FHA and just give me conventional offers. It's a great program, and this year they lowered their mortgage insurance premium. FHA is always going to have a monthly mortgage insurance that you're paying, and they lowered that this year to the point where if you I'm sure you remember there were the headlines about if you have excellent credit and you're not a first-time home buyer, you're going to be paying more on your interest rate. You remember that? It was,
right. Yeah,
it was a
that
big
was
deal.
huge.
Yeah,
that was
was
huge.
crazy.
It's like, oh my gosh, so I'm getting penalized because I have great credit and high income.
Right.
You know, it wasn't exactly what it was made out to be in the media, but at the same time, FHA had actually made their terms a lot better. And we were looking, and people with that traditionally weren't FHA buyers, we were comparing a conventional loan with 20% down to an FHA loan with 20% down. And as far as the payment goes, FHA was beating it. FHA was actually beating the conventional payment. So to your point, yeah, I think FHA is something that people need to be taking a better look at, and listing agents need to be understanding of why they're going to start seeing more FHA loans.
And that's kind of what I wonder, want to understand, is because I mentioned, hey, why don't you just go FHA? And people were like, well, no, I'm not going to do that. And I'm like, well, is it really trading that differently? Is your payment that much different? Are there things? So my question to you would be, why, if we're comparing apples to apples, same person purchasing, good credit, 20% down, and they're looking at between a conventional and an FHA, why would people pull away from the FHA? Is it because the mortgage insurance premium is higher? They can't write that portion off? What would be the things that pull them away from the FHA, do you think?
On paper and financially, there would be no benefit. If the monthly payment is lower, and the interest rate and APR is going to be lower, you're going to amortize that loan. You're going to pay down that loan faster. So it does really just come down to the connotation of, why would I pay mortgage insurance? It's just, people talk about, hey, you have to put 20% down, and mortgage insurance really gets demonized because historically mortgage insurance was pretty rough on people. Now, I mean, if you're putting 5% down on it, if you put 10% down on a $600,000 house, it's in one of the scenarios that I sent over. Mortgage insurance is it's $100 is what is on the quote, but you can go and find mortgage insurance for $75 a month. So it's really not as expensive as it used to be. But, as consumers, a lot of it is not looking at the numbers on paper, and you just hear mortgage insurance and you go, you evil mortgage broker trying to get me with that mortgage insurance, whatever it may be. But numbers on paper, if your monthly payment's lower, there's no reason not to do it. You're going to amortize, you're going to pay off that loan. You're going to eat into the principal in that loan faster.
And now, is there a point now, conventional or FHA, where that mortgage insurance goes away? Is FHA constant? Does it stay there the whole time, or does it go away at a certain point?
So if you put 10% down on an FHA loan, you can drop the mortgage insurance at 11 years.
11 years.
Yes.
So it's different than 20%. Like if you get a loan to value at 21%, you can drop it. It has to be a certain amount of time. Is that right?
Yes. With FHA, it's 11 years at at 10%. But like I was saying, people putting 20% down on a conventional loan versus 20% down on an FHA. So 20% down conventional, no mortgage insurance. FHA with mortgage insurance was still beating the payment in some instances.
Okay, and that's the good point. Is FHA, it doesn't matter. You're going to pay mortgage insurance no matter what. Is that true?
Yes.
Okay, and that's for an 11-year period.
If you put 10% down, if you have anything less than 10% down, that mortgage insurance is going to be on there for the life of the loan.
Okay, so that's the life of the loan. So that might be a reason. If they're putting 5% down, they're always going to be paying mortgage insurance. Now, what if you're putting 20% down? Is it still 11 years or is it? Yep.
11 years.
Okay,
yeah.
So that's the main reason. It's a mortgage insurance premium that I would think that people have the stigma of saying, well, I don't want to pay mortgage insurance premium, so I'm going to go with conventional. But meanwhile, this might be a lower option for you, a lower payment for you. But you can see the stigma, right? That's why I don't do a ton of FHA loans. I'll be honest. I would say 90% conventional. So I rarely see that, and that's why I don't really know the mortgage insurance premium differences in those.
Well, it definitely takes a little bit more work in the presentation. You have to be able to put things side by side and very clearly, show a buyer these numbers and say, this is what it looks like on a monthly basis. If your payment's going to be lower, you're going to, amortize that loan. You're going to pay down the principal, quite a bit faster, which means you're going to have more equity, right? So when it comes time for you to, sell the house, you're going to make more money, with this, lower interest rate. So people definitely have a stigma about the mortgage insurance. I've had presentations where you'll say, here, look at this payment. It's $100 less. And somebody just says, well, why am I paying mortgage insurance? Money's money, right? So, $100 saved, whether you're spending $50 on mortgage insurance, if you're saving $100 a month, you're saving $100.
Yeah. And that's not a like your interest you can write off on your taxes, up to a certain point, but mortgage insurance premiums, I'm assuming you cannot write those off on taxes. That's not a writable thing. Do you know?
I believe you can write off. Yeah, you can write off your mortgage insurance.
Oh, you can.
Yeah,
okay,
on an FHA loan.
Yeah, that's a good point.
Let us know your thoughts in the comment section below on FHA loans, because I think in our area, I mean, Shawn, you say you don't work with many FHA loans. I mean, your average price point has got to be like 1.1 million. Like you're selling the single family houses in Arlington. We don't see a lot of people using FHA loans, but it's not to say if one of those houses is sitting on the market, we get an FHA loan, I'm doing everything I can to accept it.
Good to hear.
No problems there. Let's move on to our next topic, and let's talk about the Fed cutting interest rates in 2024, because almost as viral as the story about how people putting down 20% were subsidizing people putting down, 3.5%, which was categorically false and a sensationalized headline. There was an article that came out November 30th, 2023, so almost a month ago, that said the Federal Reserve will cut interest rates 6 times in 2024 as the economy shows clear signs of cooling down. Now, Gerald, when I search Fed rate cuts, there's different articles that comes up. Here's why the Fed thinks it can cut rates in 2024. Federal officials say the markets are a bit ahead on rate cuts, and U.S. stocks are slipping. There's a lot of noise happening right now, and the Fed says that they're going to cut rates. People think that interest rates are going to go down in 2024. You sent me over the dot plan, which I can pull up right now. So let's talk Fed interest rate cuts 2024. What are we looking at?
So over the past couple of years, and just historically, the Fed has always taken sort of an average of these numbers for inflation, which makes sense. They look at these reports and they say, okay, over the past 12 months, where are we at to come up with inflation? And that historically works when things are pretty calm. But what we have is like this really high rapidly rising rate of inflation. So the Fed, just going back to how we got into this problem a little bit, the Fed was a little bit slow because they're looking at those 12-month averages to start raising rates. They kept rates low for a little bit longer than they should. So people benefited from that, right? We had a little bit more fun here with, these very low interest rates, and, it helped us in our business. But now on the flip side, the way I see it, we're kind of paying for that a little bit with this extended and, much higher rates than anybody was ever expecting. What's happening right now is, and, why this is happening right now, election year, whatever you want to call it, the Fed is starting to look and see what's happening right now and stop looking back at this 12-month average. And the Fed is starting to say what people in the mortgage business have been saying is, if you're looking to get to, the Fed's target is 2% on inflation. And if you're looking to be at 2% on the inflation rate, you need to start cutting rates a little bit before you get to that 2%. So that's all that happened, when you see that article that came out, all that happened was the Fed Jerome Powell and people in the Fed just came out and they just changed their tune a little bit. They didn't cut rates. They just said, hey, we're not going to increase rates. And we see that we may be cutting some rates going into 2024. And that allowed the current mortgage rates to drop down quite a bit. So that's kind of the way that you see a lot of these markets work, is just when some news comes out, people react to it. Nothing actually happened except the Fed changed their narrative a bit.
So when the Fed has meetings in 2024 and the articles come out that said, hey, the Fed met and they're cutting basis points or they're lowering the rates, if you're a consumer and you're looking to buy a house, get a mortgage, is that a sign to go ahead and pull the trigger, or have those rates already been baked in, like you said, kind of prematurely heading into that meeting?
They're always baked in. There's always an expectation of what's going to happen. And, the day before the CPI report comes out, you'll see rumors going around. They're expecting it to come in, at or below the figure that the Fed is looking for. And so the rates will respond just, on rumors and what's expected. So if you're looking right now at where rates are, we could talk about as far as, should you wait to buy or not? If you're looking right now at where the rates are, it's in anticipation of these cuts that are coming. That's not to say that they won't continue to go down once we get closer to that event and it becomes more concrete. It's like, okay, we are going to see some cuts. So we're anticipating some cuts right now. We're seeing, mortgage-backed securities respond. The mortgage rates have come down. It's helping people, bring a lot more people back into the market and be able to afford homes. But rates will slide down significantly more once we do start to see these cuts. And once we start to get closer to what we believe is, May, June, we should start to see some serious cuts from the Fed.
And do you think that's actually going to happen? There's a lot of speculation. And like you said, these rates just came down recently. And where are we? Generally, we know that you have to have good credit and everything else. But at a peak, we were where, and where are we now as far as that rate goes?
So in October, we were talking about 8% and north of 8%. Right now, if you just Google, what is the average interest rate on a 30-year fix, and you have excellent credit, 6.75. So you'd be anywhere 6.5 to maybe just south of 7% right now.
Yeah, and so the Fed have not cut rates, but the fact that they said they're not going to increase and they might be cutting it in the future, that has already affected the rate, because they're saying, all right, well, like you said, it lives in the future. So they're like, all right, well, we don't think that they're going to raise. They're probably going to stay the same or come back. So that means the interest rate now has come back. That's not because of a cut.
Right.
It's because of news.
It was because of a pivot from the Fed, where just before that, they were saying higher for longer.
Yeah.
I don't know if you remember hearing that. They said, we're going to hold on. We need to tighten things up and slow down the economy. And it was higher for longer that was the word from the Fed. Now they're saying we're going to pause. And I believe it was 15 of 19 Fed members are actually betting on cuts by May and June of next year.
Okay. And so I guess I had a prediction maybe last week or 2 weeks ago, and I said, well, the one thing that will control the rates this year, and you brought it up this in your conversation as well, because this is an election year. And whenever there's an election year, there is pressure from the current administration to make things feel like, hey, this is going good. We want the votes. We want people to stay on our side. So we're going to try to do that. So that's where I thought some pressure would come in and keep these rates at a lower standpoint. And I said, I felt like they weren't going to dip below 6. I think we're going to be living in the 6s. That's what my thought is, as being in this industry for 20 years, not knowing the mortgage industry like you do, just kind of speculation and thought of what I think is going to happen. Do you have an idea or a better idea of what you think is going to happen in 2024 with rates?
Well, I would just look and say what somebody else has predicted.
Yeah.
I haven't analyzed the data and said, I feel that I've got my crystal ball in front of me and think it's, going to be in 5.75. That's just what a lot of experts have said. We should get just south of 6% going into the second half of 2024. So, there's some great benefits to that. I think we know that, a lot of people have said that's going to trigger a ton of people to say, hey, I'll get back in the game, come off the sideline, and we're going to see, a flood of buyers into the market. And without some flood of inventory or, massive increase in inventory, that could create quite a bit of challenges for a lot of people. Going to be great for homeowners because we're going to see some pretty good appreciation, in a lot of markets.
With competition, everything else. Yeah.
But yeah, the competition is going to be back. We're going to see, multiple offer situations, contingencies. Our FHA guys aren't going to get any love. So it's good. We want to have rates lower, but we want more inventory.
Yeah.
We need more inventory.
Speaking of homeowners, at what point with the rates dropping, let's say a homeowner bought a house at 7.5, 7.775, maybe 8%. They're watching these interest rates drop in 2024. They get down to 6, maybe 5.75, hypothetically speaking. At what point are they calling you and saying, hey, it makes sense to refinance?
Well, we're calling them. And most mortgage brokers are going to be right now, and loan officers are right now looking and saying, okay, hey, there's an opportunity for you to refinance. We can knock 0.5%, off of your interest rate and save you some money. A lot of people in the mortgage business wouldn't be happy with me saying that, but if I'm a homeowner, unless you're in some dire situation where you really need to shave a few $100 off your mortgage payment, I would maybe pump the brakes and wait and let's see what happens, at that first cut in May. You don't want to, it's not totally against, good financial principles to do it twice. I mean, if you're saving money, you're saving money, but, ideally you can just do your one refinance and then, wait for some significant, other drops. Trying to do a couple of refinances within the year.
Is there
personally, I wouldn't say it's great.
Is there like a rule of thumb where if the interest rate drops by 0.5% and you have this amount of mortgage, remaining, it's a good thing to refinance? Like, what is the back of the napkin math looking like for refinancing?
Well, it really comes down to your personal plan with that property, how long you plan to stay in the property. You're going to say, okay, you're going to save $100 a month and the cost to refinance, is going to be $3,600. All right. So are you going to be in this home, for 3, and 4 years to recoup the cost of that refinance? That's it. There is no rule of thumb. A lot of people will say, well, I heard that the rule of thumb is you got to come down by 1%, or the rule of thumb is you can't pay costs, or you shouldn't pay points, or it's got to be 0.5%. It's a simple calculation on the back of a napkin. Here's how much you're saving. Here's how long it's going to take you to recoup those costs. How long do you plan on staying in the property?
Yeah, and that's exactly it. I mean, when you refinance, you have to start thinking about, all right, what's that payment dropping by and what are the costs? So that then gives you a timeline. Are you going to be in the property X amount of years to pay that difference? If you're not, then it doesn't make sense to refinance. If you think you're going to move in 3 years and you're looking to refinance now, it doesn't make sense for you to do that because the cost is too much. You can just do it. The other thing that I want to say is typically when you're refinancing, say you've been in the property for 8 years and then you go refinance, typically you're going to refinance at a 30-year fixed again, right? Mm-hmm. So you've already amortized interest for 8 years. Your payment now, what people don't understand is their payment at the beginning, you're paying mostly interest.
Right.
So as you dig in for years and years and years, you're now paying more principal down every year as you go. And so once you start getting in there further, you're actually paying more principal than interest. And so then you refinance, you're now at 30 years instead of say 22 where you were before to pay off that note. You're at 30 years and you're back again at paying full interest and not as much principal. Now, if rates drop a humongous amount, then it makes sense to do that. But if you're like pretty far down there, what is your suggestion on that? I guess it really depends on how much rate difference is there, right?
It depends on how much you're going to be saving, per month and what the costs are to it. The beautiful thing about a mortgage, it's a simple interest loan. So any additional payment you make on that mortgage, it goes straight to the principal balance. So if you do a refinance, if you say, hey, I'm only going to save a few $100 on this, that doesn't really mean anything to me. It's a bar tab, out in the night in Arlington or something. It's no big deal. I'm not going to refinance for $300 a month. But then you take a look at it and you say, okay, what if we were to do this refinance? What if we didn't call it a refinance? We called it, we're just going to lower your interest rate. If you were to just continue making the same payment that you're making now on this new mortgage, you're going to chew through that principal and you're actually going to be in a better position by making those overpayments. You're going to pay off the home faster than you would if you just stayed here and kept making, your payment at your current interest rate, although you are 8 years into the amortization. So
it's a really good point.
It's one of the beauties with the simple interest mortgage and being able to make the overpayments on it. Some of the figures on it, it's pretty cool to look at and say, holy cow. You talk about if you just make bi-weekly mortgage payments, 26 payments a year instead of 24 payments a year, it can shave like 5 to 7 years off your loan term just by making that one extra payment that goes directly towards principal. So, Yeah, the interest at the beginning of that loan, it's heavy. The amortization is heavy on the interest. So if you can make extra payments on the mortgage, it's a great thing for you.
You ever see people say that renting is throwing money away? You think they've ever looked at an amortization schedule to see how much of their mortgage is going to the interest payment?
It's
a lot.
Look at how much is going towards the principal. That's going into your, it's going into your bank account. But yeah, there is a lot that goes to interest, especially, in the beginning. It's pretty heavily skewed.
So something about the mortgages. I heard someone say that your mortgage never goes up. Shawn, you ever heard anyone say your mortgage never goes up?
Mortgage never goes up. I know that's not true.
So people say, oh, mortgages never go up, but your rent can go up. So, Gerald, my mortgage went up last year.
Your mortgage always goes up, Matt.
So I think there's this misconception out here. If I see like more people post on this is going to be like 2024 is going to be the year where 2022 was like date the rate.
Yeah.
2024 is going to be the year of like mortgages can't go up. But dude, mortgages can definitely go up. Mine went up last year.
Yeah. I mean, well, number one, you want to think about if you're comparing rents to mortgages, oh, my rent's going up. Well, if your rents are going up, that means something else is going up in the cost of things. And that's usually typically your values are going up, which are increasing your taxes, right? So your taxes are going to go up. So my payment has changed significantly because my assessed value for the Arlington County is now a lot higher than it was 3 years ago. So it's not my mortgage payment, but it is my payment per month. So that's number one. Number two is there are loan programs out there that you can get yourself caught with, and that would be like your adjustable rate mortgages. And not only that, that was sold a lot in the last couple of years because the rates were so high. They were like, well, let's go and do one of these. Or like, I mean, they were ridiculously low at some point. They were saying, well, let's just do a 7-year ARM because I don't think, we should be fine. It's like 2-point-something%. Well, now those things are at what, 7%? Actually, the ARMs aren't even trading as good as maybe a 30-year fix because it doesn't make sense, right? I mean, that's what I've heard in the past or recently. Because I was like, oh, you should just go do an ARM. And then the lenders are like, no, you don't want to do an ARM because the rates are actually not as good. So an ARM is an adjustable rate mortgage. All right. So it's fixed for a certain term. So if it's a 7-1 ARM, it's a 7-year, you're fixed. And then 1 is every year after that, it's going to adjust. So, and that's based on so many different factors, and there's a maximum that it can adjust. But the truth is, if you're in one of those mortgages, which I've had in the past, 2005 when I bought, I did whatever I could to purchase. And so those things will adjust. Sometimes they adjust in your favor, which happened to me, which was great.
Yeah.
But sometimes they don't. And that's where people find themselves in big trouble. And so saying that mortgages never go up, in my opinion, they do go up. And so you have to be careful on who you're talking to and what you're finding out. Go ahead.
Yeah, your mortgage payment is always going to go up. Your taxes are always going to go up. And the big thing this year was insurance went a little bit off the rails. So insurance costs have gone up quite a bit. And, I've actually looked into, because that didn't make much sense to me, why the insurance costs are going up. And it's actually similar to the reason that we had some of these banks that failed. These insurance companies had invested in, bonds when they were at, 2% or so. And, now they're worthless. They're not able to, sell them for as much. So that's what I'm looking at and seeing as part of the reason. It's not necessarily, you would think, okay, maybe it's the supply chain issues that we were all hearing about. And, the 2x4, now costs as much as your car. So that's why the insurance companies, or maybe it's global warming and they're worried about all these houses and on the shorelines getting wiped out. But it was a lot more to do with some of the financial moves that these insurance companies were making and, them having to, increase their premiums. So, but the taxes, they're going to get you every time. Now, you can get your taxes lowered.
How's that?
Talk to us.
You can get your taxes lowered. So
I'm listening.
I'll tell you a fun story. If you feel like your taxes have gone up a little bit too much, the first transaction I ever did in the mortgage business, we had a deal that was referred to me, and like I said, it's my first transaction I'm doing, and we've got this woman qualified. She's a first-time home buyer, single mother. Great story and everything. We get to about a week before closing, and the title company sends over an adjusted tax bill with a 40% increase to the taxes, and the debt to income ratio no longer qualified for that program.
Wow.
So here I am, the real estate agent was like, do you know what you're doing? Is somebody over there holding your hand? And my boss is telling me, you tell her you're in charge here. You're the one doing the deal. It's my first transaction ever. So ignorance in that instance was a very good thing. I picked up the phone and I called the tax assessor's office and I said, 40% increase, you all must have made some kind of mistake here. This is absurd. And, we've got a home buyer right now that's unable to qualify because of this, increase to the tax bill that you guys just put out in the middle of our transaction. They wound up going through and doing a review in about a week's period of time. This was in Leesburg, right near like downtown, Old Town Leesburg. The whole block got their taxes reduced down from a 40% increase to about a 10% increase.
Dang, was your first transaction because of you?
because I picked up the phone, I had no idea what I was doing, and I just said, yeah, well, they're going to have to lower this must be wrong. 40%, these homeowners must not have seen this. I'm the first one to catch wind of it, and I'm just simply letting the assessor's office, I'm simply making them aware of the mistake that they made.
Right.
Yeah.
I love the confidence. Hey, they owe you a beer in downtown Leesburg. That's for sure.
For real, that's what I've been saying. So
that's amazing. And another thing I want to point out, this happened to me, so this is out of experience, and I've said this before, but I bought a house that was recently renovated by a builder. And so the house it wasn't torn down. It wasn't a brand new home. It was sitting there, so it had a tax assessed value. And let's just say it was $1 million. Okay. So when my lender was doing, my payment schedule and stuff, he said, your payment's going to go up because your tax assessment's going to be higher. But the thing is, when people are purchasing a property and it's a rehab property like that, and you're doing computations on taxes that exist currently right now,
right?
The new assessed value after that project is done is going to be significantly higher. And so you have to kind of weigh in and think of that. If you are purchasing a home that has been a renovation and your lender is doing numbers based on current tax values, you should know that your taxes will go up significantly because they just put $300,000-$400,000 into that property. So think about how much more tax is going to have to be incurred because of that. And so your tax assessment's going to go up not only once, but then reassessments the next year. So if you're purchasing something that has been rehabbed, make sure that you are thinking about an increase in tax value and that the payment you're seeing right now, you're okay with and you can go higher.
Absolutely.
I got some rapid fire, maybe 60 seconds or less for you. What's the biggest mistake that consumers make when applying for a mortgage, getting a loan?
I would definitely say the number one mistake that people make is not shopping around and not looking at other options. Yeah.
Maybe they have the bank that they've just had a checking account and savings account in, and then they get the email that says, oh, we also can do mortgages. And then they just click apply on that. Possibly.
Yeah. What's nice if you're working with a real estate agent, most realtors are going to actually give you, a menu. Here's somebody that, we work with who, they've got really good conventional rates. And then here's somebody who, they do some non-QM if you're self-employed or something. So I think going with whoever the realtor is recommending and, maybe talking to multiple people based on your situation to find, the right product is shopping for a mortgage isn't fun. Got to go and tell somebody your social security number over the phone or, put it on an online application. So, people don't necessarily like to do it, but it can be something that can save you a pretty good amount of money and also just help you find somebody where you feel good about the transaction. You're getting good communication from them and, you feel more confident going into it because, buying a home, we all know it's a pretty intimidating thing. So it's a huge transaction. You want to have a team put together that, you feel really confident working with.
What about doctors? Do doctors get a really good loan? Don't they? Aren't there doctor programs out there? You do any doctor loans?
No,
you have no idea what we're talking about.
I know what you're talking about. Yeah. We don't do doctor loans. I mean, we have access to them, but the purpose of the doctor loan is banks are making sort of a investment in someone as a doctor. So they're saying, we'll give you these really great terms. We know you've got $1 million in student loan debt. and you don't have any income right now because you just got out of med school or whatever it may be, we'll give you this, loan on the house because we know that doctors make a lot of money, and you're eventually going to be in a position where you're going to be a high net worth individual, and you're going to allow us and our institution to manage those funds. So there are definitely lenders. As a broker, we have access to those doctor programs. My brother-in-law is a doctor, and he's asked me about them, and I just guided him. If we're not the best place to do it, we'll guide somebody to, who is. So if you can go to the bank, they're usually going to be the best place to give you, good terms as a doctor. Where does that come from? Who's the doctor?
No one's a doctor,
Okay.
but it just, every now and then there'll be like a post, like, I'm working with a doctor client. What's the best lender for my doctor client?
It's so funny that you bring that up, because years ago when I was probably like 10 years in or something, 5 years in, there was a lender out there, and all he was focusing on was doctor loans. He was like, you know what? I'm going to start talking to the hospitals and everything else because they're high income people. They will be, and this is like the fruit of his business, and that's what he did.
Well, not all doctors should get doctor loans.
Yeah.
A conventional, mortgage may be the best option for you as a doctor if you can, prove your income and you have enough, you've been established enough to have a qualifying debt to income ratio. But the doctor loan, as I understand it, is really for somebody who's like just coming and just starting out in their career. That's the benefit of the doctor loan, because those folks would not be able to qualify elsewhere with that slightly lower income. They don't really have the employment history. They've been, whatever it is, going through school for 12 years. So they don't have that solid employment history. And then they've got a rack load of student loans.
So you said earlier that mortgages are basically a commodity at this point. So why hasn't AI eliminated the need for a mortgage lender?
We're working on it.
Yeah.
Yeah, I'm sure somebody's working on it. And, Mabel Loans is we're working to be the most efficient mortgage company. We started out, we wanted to be the fastest growing and the biggest. And we said, well, we really want to make sure we're focused on giving a really good client experience and give really good interest rate prices, give really good prices to consumers. And so to do that, we have to become super efficient. So leveraging the best technology platforms to allow us to, be able to service high volume of clients without sacrificing the communication, has been the focus for us right now. So AI has, really come into that picture as far as, helping us with, maybe it's automated follow-ups and, things like that. I would not be surprised. I'm not somebody who says the loan officer will never go away. I would be expecting that. To happen.
The biggest and the fastest, Shawn. What was that company that tried to be the biggest and the fastest? Was that Better Mortgage? Yeah, that didn't really work out too well for Better Mortgage, because it seems so simple. You get a loan, you submit your documents, and an automated system tells you if you can do good or not. And then we've had contracts with Better Mortgage, throwing them under the bus, where it's just been a disaster from start to finish. And we're missing deadlines. We're not getting HOA payments. We're not hitting closing, and then the loan may or may not close.
Yeah, I think the one thing that for me as a real estate agent, the one thing that I look for, or the things that I look for in a lender, is one, confidence that you're going to get this transaction done, that you're not going to cause me any more stress. We've gone through this process so many times with people, and there are lenders. I'll tell you what, there's a lender this year that was, I would say, the worst experience I've ever had. It was so bad, and this loan officer was so disrespectful. He was yelling at me because I was trying to get information. I couldn't believe it. I called his boss. I never do that. I'm not that kind of person, right? But when you're causing me stress and you're causing something that should have been so simple, and you didn't tell us details of why this is happening, or that you changed loan products in the middle of it, or that you finally said, I'm brokering this out when you were doing it in-house, why did you have to do that? There were so many things that they weren't answering. And I was so pissed. I was trying to get answers, and he wouldn't give them.
Well, give Gerald an example. Sorry, just cut you off.
I was just like, I call him, and he's like, "What are you calling me for? You're the listing agent." And I said, "Excuse me?" And he goes, I have a duty to my client. Why are you calling me? And I'm like, I'm trying to get answers from my client because I need to know that we're closing this deal. You haven't given me any confidence whatsoever that you're closing this deal. And finally, he was F-bombing me and everything. And I was like, all right, see you later. And I was so pissed. And I'm like, you know what? I'm calling his boss.
Yeah.
And I found it online. I called the guy and I said, listen, I'm not trying to throw this person under the bus, but if you want good people working for you, this isn't the good guy. He should be gone. That's your choice, but don't tell him I'm calling right now because I still need to close this deal and I don't want it sabotaged. He was actually saying that he's like, do you want to close this deal? Then stop calling me. Like he was going to sabotage the deal or something. It was crazy. And so after that, talking to the boss, everything seemed to go good. He was like, oh, hey, here's an update, which I never freaking got an update the whole time. And then we closed the deal. And I was going to call them again and say, hey, listen, I would really highly recommend you get rid of this guy because he's a rotten apple. And they're out there, right? Yeah. There's not many, but that was a rotten apple. And if you want his name, I'll give it to you. I'm not going to tell you right now. But my thing is, we have enough stress as real estate agents. We have timelines. And when we put those timelines in a contract, we want to know that you're abiding by those contracts, that timeline. And we want updated. And the thing is, with my lenders, I don't want you to even call me. Don't call me. If we're going smooth, that's all. I'm good.
No news is good news.
Yeah, no news is good news. Unless something happens or, if I'm asking for something, his appraisal in, blah, 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 like get it into me quickly. I shouldn't have to ask for it. Just get it to me, right? So those are the things that I want done. But the thing is, when we refer out mortgage brokers or lenders, they're all basically doing the same thing typically in this area. And this is why you being a broker is different. Typically, we are going through people that are selling on Fannie and Freddie guidelined products. And so their mortgage rates are going to be pretty close. Yeah. But right now, the market has gotten so much higher that the littlest difference in interest rate will sway somebody. And that's what my guys are seeing now. It's like, hey, I've been helping this guy for 5 months, and then all of a sudden they went to somebody else for an eighth of a point or whatever it is. That's what's happening in the market right now. And so people have to know, one, that lenders are doing a lot of work behind the scenes to get you pre-approved, to go through all this paperwork, and then you flip-flop to somebody else. It's like, you just took all the work away from them and they get nothing. So it's just like in the real estate business, like if you're using one guy to show you a real estate, show you houses, and then you flip to some other guy because he's going to give you a better rate. Well, I just spent all this time for you for doing nothing and I'm not getting paid for it. So that's why, that happens.
And just real quick on that, and even into the AI conversation, that's terrible that somebody would say, right? You're the listing agent.
Yeah.
For us, the way we look at it, we've got to service everybody's the customer. Listing agent, the seller is really, give me the seller's number. I'll call him myself because it sucks for you to have to convey if there's bad news to the seller. So I've offered, hey, have the seller call me. I'm happy to explain what's going on in those small, minority times where maybe something isn't going perfectly.
Well, things are going to happen when you're doing a lot of product.
They definitely do. There's a lack of transparency, in the industry, like where you're not able to go in and just see what's going on. And it doesn't align with the just experience that consumers come to expect with, any purchasing, transaction. So, one of the things that we do, which I don't understand why more people aren't doing this, is we put our interest rates right there on the homepage of our website. So you can go on there, put in your criteria, your exact credit score and what your down payment is going to be, and just see what your interest rate's going to be. I don't know why, more people, they want to walk you through the presentation and say, here's why, don't look at the interest rate. Let's just look at your monthly payment or whatever it is. And so, I think as far as the AI goes, you're going to start to see more smart and informed consumers that are able to go out and say, hey, this mortgage thing isn't really that complicated. And I can go out and just pick, the best, shop around and pick the best rates, products, on my own.
You said earlier, no news is good news for lenders, unless you're working with Bank of America. We had no news after 3 weeks, and that was because they hadn't picked up the file.
It's rough with the banks.
So do you have something to say before?
Well, no, that's exactly what I was going to say. We have confidence in our lenders that we use that no news is good news. But when you're using these banks we also use lenders because we know they're fast, they're good, and they're going to get their job done. Whereas some of these other banks, they're very slow, they're big. And I always say the people that I'm referring, you've probably never heard of their bank. Most likely you've never heard of it because most people, when they think they're going to go get a loan, they're like, oh yeah, I'll go into Wells Fargo or I'll just walk into BB&T or, that's what people think. But there is a different level. And one thing I'll say is sometimes maybe you'll get a better rate there, maybe. But the streamlined process with all these other mortgagers that we use is so beneficial in my eyes, and I use them as well. And I think service and knowing that the deal's going to get done and less stress. I'll tell you, I don't know how many times I've gone to do a deal and they switched lenders on me and they used somebody else. And at the end, they're like, I understand now. I get it. I understand why you referred this person, because the hell I went through to get that rate was not worth it. And that's what you have to understand is rate isn't everything. It's the experience. It's the knowledge. It's the systems that you're using. Those things all, and it's are you going to close? You know what? When we close a deal, we're sitting right across from our client, me and Matt. Most people don't see their lender. So when they're asking the questions, they're like, well, why isn't this deal closing? I'm like, I don't know. Like in the beginning of my career, this was a lot more prevalent. We were sitting at the table, buyer, seller. I'm representing the buyer, seller's agent there. And we're like, where are loan docs? Where are loan docs? And everybody's looking at me because I'm the guy standing there representing this guy, right? And if you're not using the right lender, you're going to feel that many times. And that's why it's so important to find the right people to run your business and get you to closing quickly. And some of these other banks will take a lot longer. In this industry, in this area, in the DC market, you have to be able to close a loan pretty quickly. And if you can't, that's where your Wells Fargos and things might be 30 days, where your streamlined processes could do it in 12 days. All
right, let's move on to our final topic. This is in or out, whether you are in or out on a property. Are you familiar? You know how the game is played.
I've watched the show. I'm excited. I didn't know if I was going to get to be on in or out.
You get to. Sometimes we don't do in or out. We wanted to do in or out. So I would like to introduce to you 7558 South Turkey Creek Road in Morrison, Colorado. So this property is listed for $2.85 million. It's 79 acres. So I'm going to show you a house, but also understand that it's on 79 acres. Okay. For the first time ever, this incredible Colorado estate is being offered in its entirety. This is remarkably rare and a unique opportunity to acquire over 75 acres in the Foothill Mountains, just 30 minutes to downtown Denver. So you have 79 acres, 30 minutes. I mean, what's 30 minutes from DC? Imagine having, 70 acres in Ashburn. So this is the same architectural firm that designed John Denver's home and other iconic Colorado residences. There are 3 parcels of vacant land for your development and expansion ideas. And, you got snow-capped mountains, 5th parcel, currently home to a vintage cabin, 6-car garage, large workshop, currently occupied, of course, by the property's caretaker. So, Gerald, as you're looking through these photos, I will say to you again, 79 acres, $2.85 million. Are you in or are you out?
I think it's a steal. I'm in.
He's in.
Absolutely. Yeah,
Talk
it's a little funky stuff going on with some of the bathrooms are a little outdated looking, but, this architecture is amazing. You can replace those weird banisters and whatnot, but that right there, I mean,
you in for the circular? I mean, that's not
does
a
that
king.
Bed
that's
convey?
Not a California king.
That's not a king.
What dimensions? How do you even order that bed?
Yeah,
Does that bed show up in a box? Is that a bed in a box?
That has to get built in. And then what is this sunken bathtub situation that they have going on?
I think you just nailed it. It looks like a sunken bathtub sauna situation.
Yeah, you can scrub that. I mean, it's grimy as hell, but you can scrub that and maybe replace some of the tiling and grout in there. But it's pretty cool. I like it, and I like it for the acreage. I like that, solitude and being close to 30 minutes from downtown.
Have you been to Denver? Do you like Denver? Are you
Never been.
Yeah.
No, but I like getting out in the mountains. That's what I like about where we're at right now is you're a few minutes from DC, and then you turn around, you're, hiking the Appalachian Trail. So this is my style.
Shawn.
Cool. Well, you know me, Matt. I'm a water guy, right? I love water, but you know what I also love? I love me some mountains. I think mountains are gorgeous. There's some things about this property, like the drop ceilings in certain areas, like the yellow tile. But look at that. I mean, that right there. Views. That is the thing. Is it has such a big outdoor area, and the views are amazing. It actually has a mid-century modern feel in the inside, which again, my style. A lot of windows, views, and then on top of that, 79 acres. Heck yeah, I'm in, man. I'm buying this.
Do you ever
one.
go hunting?
I don't go hunting. I'm not a killer, to be honest. I'm
So
just not like.
I just learned, and we don't have to talk about guns on the show, but I just learned that you can hunt and do it humanely. Like if you look at the number of deer, deer are gonna like take over humans soon. Like there's so many deer.
It is. I mean,
So
that's the
it's
thing.
not like you're slaughtering endangered animals,
Right. In Pennsylvania, where I grew up, they had hunting day. Like we didn't have school the one day. Everybody would go hunting because there was an overpopulation of deer. They're going to get hit by cars. I mean, there's a lot of stuff that happens that, you need to get rid of it. You need to have population control, and that's the way to do it is hunting. Me personally, I like fishing. I love fishing. I typically catch and release. I do it for the sport of it. For me, hunting might be like me out there with a paintball gun. Shoot that deer. I got you, buddy. But I'll let it live. That's
Just
my kind of
leave
thing.
it black and blue.
I like
Just
the
send a
sport of it.
message.
Yeah.
It looks like on this property you might run into some bear.
Yeah.
Yeah. And that would be cool. Like nature, walking trails, cool stuff like that. Yeah, man. This is a good
Look
property.
at that.
Yeah.
Beautiful.
I've never gone hunting in my life. I don't plan on it with this property, but I am in. And I think we're 3 for 3. I think it's the house is just weird enough where it's quirky, but it works. And I like that there's a second cottage cabin, and I like the isolation as well as the vicinity to Denver. So you don't feel like if something happens and you need to go to the hospital or you want a nice meal, you can still shoot to the city.
Yeah, 30 miles is nothing.
I'm in.
If you're on highway, close to highway. So that's great.
Well, let us know your thoughts in the comments section below if you're still awake. And for Gerald, where can the people find you if they're interested in connecting with you?
So I'm on Instagram at Hanson Home Loans. That's a HANSON Home Loans. So send me a DM. Yeah, we're Mabel Loans is the company. We're licensed here in Virginia as well as 8 other states. So yeah, it's great. Thanks for having me on.
It goes down in the DM. Well, for Shawn, Gerald, and myself, thank you so much for watching. Until next time, we'll see you then.
Take care.